That the other advantage the individual investor has is that you really need to know nothing about investing. So you can just index. So if one were to invest in the S&P 500 index, over 100 years it's delivered 9% a year. And probably in the next few decades, just through periods back and forth, but I would say that highly likely the next few decades also will deliver 8-9% a year, which is above what the compounding rate for the Indians was. So you get 9% with knowing nothing and just buying and holding forever. And most fund managers have a very difficult time beating the index. They have a difficult time getting more than the 9% a year. And the reason they have a difficult time is for two reasons. One is, so if I buy an index, 5 basis points, 10 basis points, 0.05% or 0.1% is the amount of the fees every year. If I'm given to a professional manager, usually it's 1 or 2% a year. So first, they have to overcome the 1 or 2% to just match the index, right? So the index is doing 9, they have to do 10 or 11%, which becomes very hard. And so that's why 85% of money managers lag the index. The second reason they lag the index is that the index is too dumb to know that it owns Apple and it owns Alphabet and it owns Microsoft and it owns Starbucks, and it's too dumb to ever sell these companies. So it just sits there owning all these great businesses, never sells them. And when you look at the professional mutual fund managers, in the US, their typical annual turnover rate is like 80 to 100%, which means that their holding period for a stock is 1 year or less. And Buffett says that the stock market is a mechanism to transfer wealth from the active to the inactive. So basically, the professional managers do themselves no favors. They got the fees they have to charge for, which gives them a disadvantage. And then they will buy Apple or Alphabet or Microsoft, but they will not hold it. And they'll typically buy it after everyone else has bought it. And